Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. A very powerful line caught my eye in a presentation done by ICICI approved PMS, wherein they say that the core belief is that companies create wealth, not markets. And I know it's known to everybody, but I think it's important to reinforce this every single time we talk about market kya lagta hai before choosing where to invest and how to invest. Well, I thought, therefore, since this line caught my attention, let me try and request the head of PMS and AIF investments at ICICI Prudential, Anand Shah, to join in on Talking Point today and tell us a bit about how they are seeing the equity landscape from their prism and how they are deploying this core belief. Anand, great having you. Thanks for taking the time out. And as much as I said that we had caught up in this whole thing of market kya lagta hai, let me start off with that. Market kya lagta hai? There's been a stunning rally of sorts that we've had from the lows of 16,800. Are valuations conducive to choosing companies and deploying large money out there? Or do you believe that looking at the global landscape, maybe and the valuations, that there could be a corrective move as well?
Yeah, hi, very good morning. And it's been 22 years in these markets, and every week and every month, that's a question which hits us. And to be very honest, I keep on reiterating this that while macros matter in the short term, in the long term, at the end of the day, those businesses' ability to deal with challenges on macro and can also benefit because macros will turn positive also at some point of time and will turn negative once in a while. So, I think it's working brilliantly for us for a while now. And talking about the markets today, I think there's enough and more both sides in the sense, you always have excesses on either side. We have businesses which have, done extremely well over a decade, and now they've been extremely overvalued also. At the same time, there are businesses which are not done well for a decade or so, and now they're coming back and doing extremely well today, but market is completely underappreciated that part of the story. And I'm just talking about the way we see manufacturing, which was struggling for a very long period of time and sort of been, not created wealth for a very long period of time, is doing extremely well recently. And I think the prospects there, when we see bottom up, company after company after company, we are finding opportunities in the market in that space.
Very interesting. So, Anand, the comment. Okay, let me just first try and understand which side of the line are you on, and I'm drawing this line purposely because after a circa 10% growth in FY23 on the earnings front, the belief is of growth. It ranges from about 12-13% for FY24 to as high as 18% as well in certain sell-side interactions that I've done. To your mind, for the markets at large, one, and maybe for your core portfolios of the companies that you would have carefully chosen, what is the kind of earnings growth numbers that you are working with?
So again, if the question is whether 12% and 18%, I think we will both are possible. We will have to take it quarter after quarter because the large macro developments globally. Like if you ask me, starting FY23, the financial year went by, nobody knew what's going to happen between Russia and Ukraine and its impact, and the entire destocking cycle that went through in US and Europe, which had a significant impact, but it's not structural, it's cyclical. So the 1 year earnings growth can be either side. If we have a restocking cycle again, then we will have a good boost on the earnings, irrespective of how the domestic economy is doing. Having said that, I think I again reiterate that the earnings growth for the Nifty as a whole has changed. In the sense, if you see prior to January 2020, maybe almost for a few years, we had a negligible earnings growth rate at aggregate level, be it Nifty, small cap, mid cap, because of various challenges, be it asset quality review, be it demonetization, be it NBFC crisis, real estate slowdown, and so on and so forth. I think that's changed. I think the interesting part of the earnings for the last 2 to 3 years has been that it's more broad-based. Not only the consumer-facing businesses, by virtue of their pricing power, continues to do okay. The other part of the economy, which was B2B businesses, the manufacturing, the miners, they were struggling for almost a decade and a half. They have also started doing well. So at aggregate level, more companies, more sectors are doing better than they were doing the previous decade. I think that's the big part or a big picture story of the India Inc. as we speak.
I would suspect, therefore, that you would believe that your core portfolio companies would be able to clock in a strong earnings fiscal in FY24, presumably FY25 as well.
Yeah, it's easier to predict 2 to 3 years than to predict next 12 months. But I say that if we have a nominal GDP growth rate of 11 to 12%, we should be able to identify businesses which will do better than that. So I think earnings growth front, in combination of the reasonable valuations that we have in our portfolio companies, I think we're very comfortable with the markets at this point.
Where is it loaded towards? What direction? I mean, just trying to understand. You uttered manufacturing twice in the first 5 minutes of this conversation already. I'm trying to understand if manufacturing is the bulwark of the portfolio, and how have you structured it per se?
So I think the interesting part of the portfolio today is what we don't own, because that will give you a lot of clarity. We don't own too much of IT services. We don't own much of pharmaceuticals. We're significantly underweight that area, and we are also underweight consumers, the FMCG, the fast-growing consumers, which is, in a nutshell, a lot of B2C is something which we don't own. A lot of B2B is what we own. Be it manufacturing includes engineering, cap goods, metals, textiles, even defense companies. So anything and everything which at some point of time is to compete with China, or even today competes with China, had a torrid time. I think they have come out of that. I think competition from that part of the world, by virtue of increasing labor cost, increasing pollution costs, increasing cost of capital and electricity prices, there is reduced. And to that extent, that part of the economy is, and even the corporate banks. Corporate banks were another piece where it also was impacted significantly, as many of the corporates defaulted, and there was a secondary level impact in corporate banks.
Okay, that's interesting. Let me try and probe you a little bit on some of the stuff that you don't own and some of the stuff that you own. Manufacturing. The argument around, let's say, let me start with cap goods. And there are some which are priced supposedly to perfection, some which are not. But the argument is that even if there is a repeat that we see of sorts of 2003 to 2008, it will be different in the sense that the nature of the work demanded from the listed Indian space is more of niche areas, expertise, automation, as opposed to orders going out lock, stock, barrel across the whole chain. Are you in consensus with that? How are you choosing to keep or add newer manufacturing-led companies into the portfolio?
Indeed, I think you're bang on, and obviously the entire Capex cycle, as we speak today, even the private sector Capex cycle is still waiting in the wings, in the sense it's not full-fledged. It's still driven by government, still driven by railways, defense, to some extent on the power, roads, airports and other places. So I think you're completely right when you're saying that it's a very different. Capex cycle was led by power plants, particularly thermal-based plants. The road infrastructure, we were just starting off, so that was also a big driver. Irrigation was a big driver then. So to that extent, it's different. We have to do a lot of import substitution on many of the goods we import. Entire electronics piece, which we've been importing, how much can we substitute, how much can we manufacture here, and tomorrow can we export out of India? But the low-hanging fruits are, to be very honest, are the ones which are existing and they have survived last decade. So While the new emerging manufacturing companies will come up, we are seeing IPOs uh, coming in that area maybe every month, every quarter. So here's the new business, but even the existing manufacturers who have also survived, and not only survived, have planned themselves for the future. So there are enough and more companies today who have also diversified away from the domestic market. They have created exports market for themselves. They have fine-tuned their balance sheet so they can survive any sort of competition that exists globally. So they have become more cost competitive. So yeah, the areas are everywhere. Again, as I said, there are enough companies in that area also which might be very expensive, might not be at a juncture where you would want to buy them. So it's not a straightforward and a simple that you can buy anything in that area. But yes, there are opportunities. That's where I started with saying, look, today when we are looking at the broad spectrum of businesses, we're looking at 400, 500 companies. And when we drill down to 25 companies, 30 companies, 40 companies for our portfolios, we are seeing more and more businesses from B2B side, which are figuring out in that.
Got it. And therein lies my second question, Anand, which is while the focus is on B2B, the commentary from the real estate stroke construction ancillary companies continues to be very positive. If anything, they are seeing heightened um, capacity utilization levels and confidence around the next 2, 3, 4 years. But that is more a B2C, even though you could argue that there is a B2B element in supplying to the real estate developers themselves. So are the real estate ancillaries a pocket that you are constructive on, or has it run its course, so to say?
No, we do own a couple of names in that also. And again, it's more geography specific. There are geographies in India where the growth led by IT and other sectors would create jobs. I don't think, as far as Indian housing demand is concerned, we have reached anywhere where we're saying, look, it's reached a point where there is no saturation. No, of course not. I think households will need more real estate, and post RERA, it gives much more confidence to the buyers as well. Post SURFACE, as the housing finance companies could actually go out and lend to that sector. So I think the new regulations will only further spur both the demand and the supply in that area, and should lead to a good growth there. As far as the auto ends, I think that's what you spoke about. There also, I think there are companies which are dependent only on Indian domestic, or they're only dependent on ICE engine. I think those might be at a certain risk. But then, as I said, many of them have diversified beyond Indian markets, have developed products for the future EV, space. And to that extent, we'll have to again be very, very selective in those areas, especially when it comes to auto, where we are seeing, a terminal risk of entire IC regime.
Okay. Yeah, actually, I was asking about real estate ancillaries, but I'm glad I got the auto answer as well in the bargain. Anand, no, but completely welcome. The other aspect that I wanted to check with you about is this whole China situation, and the fact that the recovery has been a bit underwhelming. There's a lot of chatter around some more stimulus measures coming in, and to an extent, it would have impact on globally exposed sectors, particularly metals. I know in the past you've told me, if I'm not wrong, that you don't look at commodity plays that very closely and that higher weightage in the portfolio. Trying to ask you if you still on the same line.
No, so to be very honest, China has been two-pronged. Basically, the demand is an issue. And in the past, if you see, the supply was also an issue. China was also not only a big driver of demand. If you ask me, on the metals, they consume more than 50% of the most of the metals. But incidentally, they were also a very large producer and exporter of those metals, and somehow they dictated the prices globally. What is changing? Obviously, last 1 year particularly has been tough as far as demand is concerned. They had a lockdown of a very long period, and now the recovery has you said, is not up to the expectation. It's slow. It's not a V-shaped recovery that we otherwise saw in the rest of the world post lockdown. But I think the discipline on supply is something which we are very, very closely watching. As I said, China does not have significant advantages that it had a decade back. Most importantly, being the cost of labor, but more importantly, the cost of pollution. I think under the new regime, the blue skies are very, very important. I think it's very obvious that this is a very prosperous country now than what it was a decade and a half back. And to that extent, high energy consuming, high polluting industries would have continuous pressure in terms of production. And to that extent, those industries, which includes metals, have a little better breathing room than what it had in the previous decade. That's what I was.
So are you constructive on metals? Because, I mean, for example, when I look at your Contra portfolio, right, there is presence of metals there. Is this a recent addition? Are you constructive on it from a medium-term perspective? Can you tell us a bit about it?
So again, as I said, near term is challenged. As I said, China being 50% of the consumer of any metals, it's a challenging situation, but rightly so that over a medium to long term, as I'm saying, China cannot be a large producer and exporter of that metal, and that leaves some space for the Indian metal producers to not only satisfy the domestic demand, but also satisfy the demand in the exports market, which will be left open by a prosperous country like China. That's what I'm saying.
Okay, fair call. So because I'm just trying to ask you, because you run a concentrated mid-cap and small-cap strategy, and you also run a contra strategy, and out there too, there might be presence of companies which are not necessarily large cap, but a broader end of the spectrum too. Where is it that you are really contrarian? I'm just trying to understand where you are significantly overweight, your stance is significantly bullish relative to what the markets may think.
I think a couple of things. One is corporate banks. So while generally people are positive on banks, we've been more inclined, including some of the state-owned banks. I think that's our belief is we are a little bit contrarian versus, given that they've already rallied and people believe that they've reached a point where the valuations have no room for expansion. Our take is a lot of these corporate banks would surprise positively on the earnings front over the next 6 to 8 quarters, given that the net slippages would be fairly low. The credit cost will be significantly lower than what we have seen in the recent past. That's one. Other, as I said, multiple number of companies within the manufacturing and manufacturing allied, which constitutes more than 56% of our portfolio, where I agree it's not as contrarian as it was maybe a couple of years back, but all these companies have delivered earnings growth rate, and at the aggregate level, the stock price performance actually is lagging the earnings growth rate. To that extent, the valuations remain still compelling. So there's no reason that since they have rallied significantly over the last 2 years, we need to exit those companies. So I think they still remain part of our portfolio, given the market is still underappreciating the turnaround on balance sheet. Their balance sheets have improved, turnaround in their return on equities. I think that's a very, very important ingredient in any business and any stock price, particularly today. We are more conscious of return on equity now than ever. Both the quality of balance sheet has improved, the return on equity trajectory has improved for these businesses, and that is not yet reflected on the valuation of those businesses.
Got it. My final question, PM Modi's visit to US, subsequently Egypt, but US predominantly, and we saw a lot of sound bites from large global corporations about increasing their investment into India. Actually, it happened preceding the visit as well. G. Hal being the poster boy, but a bunch of others. Now, my question is, Anand, it will not be an isolated case, I presume, and therefore we might well see a large portion of global companies increasing their investments into India for manufacturing or otherwise. Is there merit in trying to look at some of the listed MNC businesses which are well performing in nature, because they might get a larger slice of their global parents' focus into them, both for the India piece as well as for making in India for the rest of the world. We've seen sporadic commentaries of there from some companies already. Is that a valid way to think about these businesses?
I think again, it's a trend. Uh, the China plus one, which we've been sort of talking about, and to be very honest, the quick question which I get is, where is the private sector capex? And obviously, it's not to the extent that one would want. But if you see MNCs, in particularly in manufacturing, have announced capex. It's very easier for them, given that they already have a captive market, and they can shift some of their production base immediately. And to that extent, those capex decisions for the multinational manufacturing companies would be much more easier than an Indian manufacturer who has to still today go out, prove itself, uh, get some order, and then put up a capacity. So I think on the contrary, when we scan the market today and we see the capex announcements of manufacturing companies across, MNCs stand out. Actually, MNCs have been ahead of the homegrown manufacturing, at least in the listed space, in terms of committing money on the new capacities, expansions, brownfield and greenfield expansions. Given that for them it is easier to sell those capacities than their homegrown businesses.
Fabulous insight, Anand. Thanks. This was lovely to understand, and an important one which I had not thought of. So thank you for that. But thank you for the whole interview as well. Lovely talking to you and getting some of the thoughts around your portfolio construction strategy and your core belief. And looking forward to talk to you more often.
Thanks for having me.
The pleasure was ours. And viewers, thanks for tuning in to this edition of The Talking Point.